from Food Coma. So this is going to be a quick one. It's going to be 20 minutes, so we're going to try to be super efficient. I'm Rob Hadick. I'm a GP at the fund Dragonfly. We have Guy from Ethena and John Egan from Stripe here. Guy is the founder of Ethena, and John is the head of crypto at Stripe. So we're just going to get right into it. So, Guy, can you tell us a little bit about SUSD, USD, what that is optimized for, how that is different from USDC, USDT, which I assume most people here are familiar with, and what your product is optimized for?
Yeah, sure thing. So I guess a bit of background on Ethena for anyone that doesn't know. Came out to market about a year ago with the product, and it looks quite different in terms of its construction versus normal fiat stablecoin. So the idea here is instead of holding T-bills in the backing for what you're representing as a digital dollar on chain, you're essentially taking crypto collateral and then delta hedging that collateral with derivatives, and that allows you to issue what we call a synthetic dollar. One of the interesting byproducts of that is that you're capturing a huge interest rate within the crypto markets, which is known as a funding rate. And so when traders are trying to be long derivatives on centralized exchanges or on chain, there's an interest rate that they're willing to pay in order to do that. And you can really think about Ethena as really supplying capital into these derivative markets and then capturing an interest rate in exchange for doing that. So I think that was like one big piece for why Ethena's product was interesting to people, was that it was a really untapped piece of the market where no one had really captured or tried to tokenize this enormous source of cash flow that sits within the futures market. And one of the interesting pieces is that we sort of made that yield bearing in a token that sort of looks and feels like a stablecoin that you can start to use as collateral in a bunch of different places, both within crypto and on chain, and then within CeFi as well. So I think at a very high level, we sort of see 4 different use cases in the world right now for stablecoins. I think you've got payments, and I'm sure we're going to talk about that as a heavy piece through today. But then I think the core use cases that we see people using stablecoins for right now is really trading collateral within exchanges. So just using USDT to buy crypto on Binance is obviously one of the largest use cases that you see now. Another one is sort of dollar rails for anyone who's existing outside of the US banking system. So just being able to hold a dollar in an emerging country is a huge benefit for these people as just a store of value. And I think the places that Ethena is trying to actually target and say that we can do things better than existing fiat stablecoins is where you're really trying to use it as collateral within DeFi, or for when you're trading on centralized exchanges, where being able to capture that interest rate that I described is a really powerful differentiating factor versus the existing product. So
collateral, that's what you think is the main use case today, or the main product market fit. Obviously, there are also centralized versions of things like Hashnote and Ondo, and Circle acquired Hashnote last year, and those are trying to do somewhat similar things, or at least be used for the same types of use cases. Why is USDE a better product for that?
Yeah, I think it's just the interest rate on treasuries is not interesting enough to most people within crypto, which just have a very different cost of capital. So generally within crypto, you can sort of think about the funding rate really as the average cost of capital for dollars within the system. That's generally averaged anywhere between 10 to 15 to 20% in most years. And so 4% on T-bills is just not interesting enough to most people. I think another piece that people sort of overlook a little bit is that being able to generate 4% for your collateral sitting on centralized exchanges is pretty insignificant actually relative to the liquidity benefits that you actually capture by using stuff like USDT. So if you're speaking to a high frequency trading shop or a market maker, when they're coming in and out of trading pairs 1,000 times a day, just being able to save 1 basis point on that trade is worth 100 times more than earning 4% on that collateral with the T-bill. So I think it really is just a cost of capital sort of issue where T-bills aren't really well suited for the cost of capital within crypto.
Got it. So you mentioned payments as another use case. Obviously, we have John here from Stripe. John, tell me a little bit about why stablecoins are so interesting to Stripe. You guys obviously have a humongous business, 1.4 trillion of transaction volume last year. You acquired Bridge, and you talked about stablecoins in your annual letter, even though, at least today, it's likely de minimis towards your business. Where do you see the market going? Why are you so excited about it?
Yeah, I think we're trying to make it pretty clear that we consider stablecoins and the sort of economy that they're enabling to be just native to Stripe's core vision. I think if you look and go read that annual letter and you see sort of the reasons that Patrick and John really laid out for why we think stablecoins are valuable, he had sort of the 4 points in there around speed, around cost, around default global availability, and programmability, right? And like, if you sort of squint, these are all things that like Stripe has been promising developers since the very beginning, right? Except on top of this kind of traditional financial ecosystem. And so stablecoins really are an accelerant to us from that standpoint in a number of ways. If we take payments very specifically, I think it's easy sort of in this room to really think about it from a like, okay, what are all the things we can create that are sort of new with stablecoins, and what are all the like brand new companies we can go build with it? But for a lot of merchants, they're really just looking for that global access that stablecoins are starting to enable. You can think of them a little bit more like, okay, I'm a US multinational and I want to take payments from Sweden. So naturally, I'm going to go and hit that little button to turn on Swish, right, to enable a local payment method in that country that then settles locally for me as fiat. It's the same thing for crypto for a lot of these companies, especially stablecoins, where it is, what is the one button I can click that turns on a global LPM and enables access to a currency type that's rapidly being held. So you're correct that like the primary store for stablecoins today is on centralized exchanges and sort of as a settlement layer, but that's starting to change. Right? What we're starting to see is a rapid growth in use for commerce, especially B2B, but also C2B. And so Stripe is really right there. We're very well positioned in our existing merchant relationships to go and enable that transaction layer to be as easy for the consumer as it is for them to make a credit card payment.
So, you kind of started talking about it, right? That, there's 225 billion of stablecoins today. Most of them are in CeFi or centralized exchanges or DeFi. Most of them are used or are being used for collateral for trading purposes or some sort of financial primitive. And payments is not something that stablecoins are being used for, at least as large as we would like, or as much as the conversation around it would suggest, I would say. What is the main reason for that? Is it the intermediaries haven't been there that are able to, to on-ramp, off-ramp? Have there just not been sophisticated actors like yourself that have come into the space yet? What has caused that to not take off in the way that we would have expected today?
So I think it's a mistake to think we're too late, right? Like this is a classic crypto fallacy, is we think that we're late, right? We're really early. The inflection point for stablecoins having sort of payment type utility is really only happened in the extreme near history, right? Maybe over the last year. And so the centralized exchange usage was really fantastic in terms of just proliferating these coins all over the world. And now the people who are holding them are looking for utility, or they're looking to get more access to those coins. And so I would kind of challenge the base point of like, it's not where it ought to be, right? It's like early and growing exponentially and starting to be more interesting to larger and larger businesses. And it's actually really starting with businesses that care most about global access, right? So sort of multinational access. We're seeing rapid growth from AI companies doing billing, right? For like global, other global businesses that are starting up in that space that want to pay with dollars. We're seeing like rapid growth from companies like remote.com that are doing, global workforce payments where Dollar Access wants more access. And then you've got like Bridge, who is now part of Stripe, which is super exciting, doing things like orchestration for like large multinationals like SpaceX, who have to operate in local markets all over the world, but want to be able to repatriate those funds aggressively. So I think we're right where we ought to be. And it's sort of the perfect moment for a company like Stripe to go and create that utility. I say a lot of the time, like we're really not the evangelists in this space, right? Our job is to provide utility to our merchants to access trends in terms of payment methods that consumers would prefer. And so I really see us sort of standing right there and being right where we ought to be in terms of that inflection point and that adoption curve that we're seeing with stablecoins today.
That's great. Okay. So obviously you mentioned USDT and USDC. I assume that's most of the flow that you see today is those two stablecoins.
So on Stripe, primarily USDC. But yes, if you look at the data, right, globally,
USDT.
Right, those two.
Yeah.
Yep.
How, Guy, do you think there's a world in which USDE and other, call it more on-chain DeFi native stablecoins can bridge the gap to Stripe? And I'd be interested in John's perspective too after you answer.
Yeah, I think when you're building a startup, you have to be quite honest about with yourself around which markets you can actually go and attack or where you can actually compete. And I think we always took the view that a new startup coming into the market would never be able to sort of compete on their existing turf of payments. It's we can go into a Stripe or a PayPal and try pitch why they should use the product when clearly the end state is they're just going to internalize that and try to do it themselves, as you guys are sort of doing now. So I think the view that we had was, can we be supportive in terms of the way that they are trying to manage a very different looking business model going forward? So if payments companies in the world, and this I think is like $1 trillion question for these companies going forward, actually switch from like the existing business model to using stablecoins for everything, it's a very different business model, right? It goes from flows-based, transactional-based, where you're clipping a very small fee on the amount of volume, to something that looks like a balance sheet-driven business model, which is what a stablecoin is, where you're just getting a net interest margin on the assets that are sitting there. If the world does actually decide that they want to settle on stablecoins for everything going forward, there is a role where I think we can play, sitting in the background to actually manage and optimize the yield for these like balance sheet driven business models. But I don't sort of see a world where we're, default use instead of something like USDC or PYUSD that PayPal are using. I think it's more back-end infrastructure that we can sort of support them in terms of generating more on their existing balances.
John, what about you?
Yeah, I think one of the interesting trends we're seeing is, certainly USDC, USDT is what you see kind of in the vast majority of the external market, but we are seeing a pretty rapid growth and interest in infrastructure coins, right? So coins used internally by these large-scale organizations, primarily backed by an interest in having some control over like the reserve, the risk models, the compliance nature, and I think we're seeing this especially through the bridge relationship now, where as larger and larger merchants come on board today, when you make a payment with Stripe, that settles down to fiat for convenience, because that's sort of the expectation of your average Web 2 merchant today. But we're seeing much more demand more recently, which is, well, maybe it should settle to a stablecoin. And more interestingly, maybe it should settle to a stablecoin for us, right, from the merchant standpoint. So I think that's a really interesting trend where perhaps in the future there will continue to be a countable number of sort of external and publicly available coins, but there may be an incredibly large number of internal infrastructure coins managed by the corporations that are participating in the space.
How much of that is because they think they can, clip some form of yield, and it just essentially looks like a, treasury management or money market fund for themselves?
I think a lot of it is that today. I think we'll start to see a trend towards sort of unique programmability of those coins over time. But certainly it's an obvious answer today, right? Is like, how do I go and capture all of the interest?
How risk-on do you think those merchants will want to be? So obviously, USDC has their relationship with Coinbase, so they're not really able to share the same yield that you might from, some of the other startups like an Agora USD or some of these others, or something like Guy's product, which has, should have a potential to give back even more yield. Like, where do you think those merchants go? How risk-on do they get?
I don't have a great answer yet. I think we're super early. I think the competition is healthy. I think like that's one of the kind of wonderful things about the blockchain space in general is we'll ultimately get winners and models in the space that reflect what are probably best for the individual merchants that are attempting to compete. But no, I don't think it's clear at all yet where who's going to emerge and what specific model is going to win.
And do you think, and as you mentioned, most of the flow today is, it is just that, it is flow, right? And then, it immediately comes off into fiat, into some bank account. So, when you look at like Circle's business model, they are essentially making NIM, right? And so if it's just, okay, a transaction that's a stablecoin sandwich and it's fiat and fiat on both sides, that's not good for them, at least not the way they monetize today. Do you expect that'll continue, or do you expect that, or how much do you expect that these merchants will keep stablecoins in the future?
I'm only going to answer the last part of that, which is that I think more merchants will hold stablecoins in the future. And I think we're already starting to see that trend. And I do think we have some positive regulatory tailwinds to that.
Got it. Guy, when you, kind of on the same line of questioning, when you go and talk to fintechs, PSPs, payment companies, and you talk to them about your product, do you have the same type of conversation with them? Are they, comparing you or contrasting you with like a USDC and saying, hey, we'd actually really like that yield? Or is it more, hey, listen, it's really just about, call it, payments with fiat on each side, and we're looking for more of those transactions and that quick programmability and to then get into fiat on the other side?
Yeah, I think there's a natural sequencing here where, the entrance into the market, as we were saying, has only really been in the last year, I think, for payments companies. And I think there's, what we're doing, I think, is just 2 or 3 steps ahead of just getting your foot into the market in the beginning. So I think they definitely have a view, and it sort of changes definitely with the interest rate cycle as well going forward, where, holding USDC or T-bills right now is like on decade-long measures, like one of the most attractive times to sort of have that as a business model. But people can look forward and understand that, like, at some point in the future, rates aren't going to be at 4 to 5%, and there might be some other sort of source that you need to think about. So definitely having the conversations, but I think it's less immediately actionable now, where there's so much that they still need to do to sort of get in and get the basic infrastructure set up. But I think there is a view at some point in the future, you need to start thinking about that NIM management in a different interest rate environment as well.
And are you seeing a different reaction to you in different geographies, as U.S. versus call it Southeast Asia or Latin America, places like that?
Yeah, I mean, we when we rolled out the product, we actually didn't sort of serve a retail user base within the US, and so at the moment it's actually less focused on the US in general. Generally found, I think, more traction within Asia, and I think that that's actually where sort of the center of gravity for crypto sort of sat in the last administration. Obviously, it feels like it's changing quite a bit now. But yeah, I think our presence here is almost zero on like the retail side, and hopefully sort of get to an environment where that can change. Yeah.
And John, how do you think about that geographically in the way you play? And you're mostly focused on USDC, and it's mostly been a US business. And how do you think about those domestic payments or domestic use cases versus international ones?
Yeah, I think maybe the most interesting sort of domestic use cases, at least as it relates to kind of the cross between the US and the rest of the world, has to do with sort of the marketplace use cases, right? Where it's generally a US entity sort of running the marketplace, but it's international players, and the stablecoin becomes sort of that common currency that's used both within the market and outside of the market. So you're not having an FX moment every time you're coming in and out. We're seeing a pretty interesting sort of closed loop situation evolve for those types of organizations, where it becomes lower barrier than for the international participants in the marketplace who are buyers to then turn around and be sellers, or the other way around, because they're utilizing that one currency without coming in and out of the local fiat, which I think is like a really interesting trend, in that space. In terms of the other parts of the businesses, the pay-ins business, right, the payments business, the local payment method for the world business, like that's very much a global business. We really see that everywhere, and we see it in interesting ways. We see it both in like small payments just from around the world, but we see these kinds of sort of like large scale B2B payments as well. I think the AI use case, there was a company, Shadeform, that recently tweeted just about how much they're appreciating, invoice payments on stablecoins. And it turns out that, their customers were just maxing out their credit cards, from like other parts of the world to make payments. And it wasn't really a dollar access problem. It was just like, it's far more efficient and easier not to have a credit card limit, right? And be able to just pay this like very large invoice instantly, and to be able to run your AI business. So I thought that was pretty fascinating. On the payout side, and certainly on the remittance side, right, it's the places that you would kind of expect where those businesses are growing really quickly, right? It's like Latin America, it's certainly APAC, and just kind of these sort of like global centers where we see like US outwards remittances occurring.
Great. Okay. I think we got about 1 minute left, so I want to hear from both of you. If stablecoins fail or don't fulfill the vision that you have for them, what went wrong? And don't tell me regulation.
I think it's I think there's a complexity risk, right? I mean, these things are competing with like the credit card networks, which are wonderful consumer experiences. We can walk up to a coffee shop and we can tap our card and we can have a coffee in seconds, and no one questions what happened, right? It's tap, approved, done. Right? Even in the best case, the sort of stablecoin checkout experience isn't there yet, right? You're picking a wallet, you're picking a chain, you're picking sort of a transaction-like method. You're sort of not sure how you're going to get your receipt. There's a lot of work for us to do, but really there's a lot of work for the industry to do, I think, around what does cross-chain look like? What does sort of consistency of UX look like? What do the wallets look like? And I think if we don't get that right, we can end up with a really fragmented industry where you're sort of trying to check out and you're just faced with, sort of you go to some of these exchange sites, right, and you open it up for like USDC and it's like 300 options, right? It's every single chain. I think that's a real risk. I think the user experience risk is incredibly high, and could actually hold the industry back to the point that traditional finance could make other actions that overtake.
Yeah, I think a couple of pieces. One is I think we're getting towards the ceiling of how big stablecoins can be if they're only within our own sort of internal systems of just trading within crypto and that kind of stuff. I don't think that that's a multi-trillion-dollar opportunity if that's sort of the sole use case that we're focusing on now. If we don't start to penetrate into real payments use cases, which obviously Stripe is sort of like leading the charge there, then I don't sort of see stablecoins reaching that sort of trillion-dollar outcome that I think a lot of people in this room expect. I think the other piece, as we're alluding to, is also it's a commoditized product that naturally you wouldn't want to break into many different instruments with different sort of people sitting behind them or many issuers. I think one thing that we run the risk of doing is that every single fintech and new entrant into the market now wants to create their own stablecoin and have it sort of in-house, in-branded, and own the entire stack, when really there isn't much differentiation between the product, right? It's supposed to be $1, and that's all it's sort of doing. I think part of the risk that we sort of like run into here is that you might have 100 different stablecoins, one issued by each exchange, one issued by each fintech, one issued by each payments provider, and I think that actually creates like a net user like worse user experience basically on the other side, where it's sort of bifurcated in terms of liquidity. So yeah.
Awesome. Well, thank you both for all your insights and for your time. Thank you for the audience. So.
Thanks.